A happy Tuesday, traders. Good morning to Kay, Stel, and we've got a special guest today, Michael Brown from Caxton FX. Good morning to you all.
Good morning, Ryan. Good morning.
Good morning, everybody.
Morning, all.
Hey, good to have Mike here. Hi, Mike.
Hi, Estelios.
Yeah.
How you doing, mate?
Very good, thank you.
Yeah, very excited to have Michael on. A good follow on Twitter at Mr. M Brown, is it? Can't remember your Twitter handle now.
Yeah, that's the one.
Yeah,
MRM Brown.
We're well rehearsed this morning.
Yeah. I'm never well rehearsed this morning. I'm always scribbling my notes right up to the last minute, but that's how good show should always be. So good morning to all our traders in the room. Michael's going to be talking a bit in a moment about the FX market, the other side of the FX market, which I think is very important for traders to learn about. So we'll run through the bits and pieces, the usual bits and pieces that we do, news and data and stuff before we get into that. So we're going to start just quickly looking at yesterday's data. We got the durable goods, which came in for May, surprisingly upbeat. We're looking to see if we're going to get any weakness. We spoke yesterday about Target and Walmart and their big inventory building and then halting all that and going into sales of those inventories, cutting prices and that sort of thing. And we're looking to see whether that was going to start impacting the durable goods. It doesn't look like it has on the whole. So it may be that if we're going to see that, it may be the June numbers where we see that impact. But by and large, the numbers were pretty good for durable goods across the broad range of the different sectors that you look in there, from household goods, electronics, computers, all that sort of thing. No real disasters in that at all. So it tends to insinuate that from the consumer side of things, business is still ticking along, the consumer's still happy, and therefore shops, services, retailers are happy to continue buying goods from the producers. After that, we got the pending home sales, and another one that particularly surprised with a positive number that broke a 6-month negative streak in that metric there. So pending home sales coming up 0.7%. So that's two housing metrics now in May: new home sales and pending home sales that have bucked the trend that we're looking for in the housing data. Maybe it's a dead cat bounce, who knows? There is worry still developing there. So again, this is going to be something to look at on the months ahead. What was most interesting is that we got a reaction in assets and in prices. We saw the dollar bid up a bit on that. We saw yields jumping again over the data. So we're just seeing the data having an effect on prices, which is good volatility for us. Obviously, we're getting into the thick of the month end, quarter end, half year end stuff now. Today is value date, end of month. So this is the day when the US corporates mainly do all their fixing and all their rebalancing and any bits and pieces they need to do. So far, one of the models we're looking at is looking for dollar buying. The US corps is that main factor anyway, dollar buying. But we're looking at seeing what's going on. We got a fix yesterday in the euro dollar, which saw it running up into the fix. And that was actually a move that I just tapped for a small position up at 1609. Just to play, see if it was a bit of a fixed move. Got a bit of a pullback. Not anything really huge we're seeing at the moment in the fixed moves. Most of the pairs still sitting in tight ranges. Cable, looking really tight at the moment. But that's something that needs to be watched, as we said, around about the hour mark, and particularly as we get towards the London fix later on today. While we're in the pound, looking at the UK and Brexit, the UK passed the second reading of the Northern Ireland Protocol Bill. It passed quite strongly, 295 to 211. So that shows a fair amount of backing for this bill. This was the second reading, and it goes through a whole long list of procedures now, committees, debates, 3-day debates. There's a real lot of stuff to go through now, people tabling amendments, that sort of thing. But it was a pretty strong pass through. I'm not sure what the time frame is for the third reading, but it goes to the House of Lords, then the House of Lords vote on it and put any amendments in, and then it comes back and it goes back and forth and ping pongs around. So there's a long way to go on this, and all the while the threat of passing this bill in full is still there, and that's going to be the negotiating tactic, if you like, as this bill progresses. Are the EU going to fold and look to come back to the negotiating table and bow to some of the UK conditions, or is the UK going to plough on ahead and enact this bill at the very end? So lots of stuff to go on there, but we are through to the second round, and we'll see where it goes from there. China, there's a bit of news out this morning. We saw a bit of reaction in dollar yuan. There was a headline came out that they're going to loosen up the quarantine time for overseas travelers coming to China. So further signs of opening up there. We got a bit of a, as you can see there, a bit of a spike down towards the support area that I've been looking to trade. I did have a bid in at 6.6680, which just missed by a handful of pips. I'm getting a bit cautious that we're coming down to this area fairly quickly. So I've removed my 80 bid. I'm sticking with a 6.6650 bid. And I'm tightening my stop up a bit to just under 6.64 or 6.65. But there you can see the support area pretty much held around this zone, and we've had a bounce since, but I still want to see it push right up so I can take further profit and look for potential shorts if we get up to 679. On to the ECB, and it's full of ECB wafflers today. We've already had Lagarde out, Kazakh's out, a couple of others. The main gist of everything is that a 25 pip hike is on the table for July and 50 pips for September. But as per usual, there's been no slamming of doors, and so the door is open for a 50 pip hike in July. I just put a tweet out earlier, not too long ago. We've got a lot of data this week, and it's all the flash readings for June in CPI. So potentially for me, that's going to be the kicker, whether it goes 50 or 25 pips. If we see much hotter numbers coming in, I think we get Spain and Germany tomorrow. If we get much hotter numbers, we're going to get those 50 pip hikes put on the table. We'll probably get a load of ECB members out again saying that they're ready to do more. And it just depends on whether that gets the market shifting its rate expectations higher. You know, maybe it will start thinking, well, if we're getting a 50 pip in July, maybe we're going to get a 75 pip in September. Whether that's going to be based on anything other than speculation, I don't know, but we've seen the market getting ramped up on expectations over all different central banks, the Fed, the RBA. So if this inflation data is hot this week, and we also got economic sentiment from the Eurozone, which contains CPI metrics, selling price metrics, then I expect the chatter to ramp up over the size of potential hikes. That could be an influence for the euro moving forward until we get to the ECB and they finally put us all out of our misery. So that's it really on the news things, unless you got any headlines, Kay, that you heard about, or Stel?
Yeah, the interesting one overnight. Hello, everybody. The interesting one overnight was that little chat between Macron and Biden about the Middle East oil, because Biden is trying to push the Middle East to increase their oil output, but then that got killed a little bit. There was this. I think staged leak that Macron was talking to Biden about the Arab nations, and he said that the United Arab Emirates were at max capacity and the Saudis can't produce much more. He was talking about 150k barrels or so per day, or a little more. So that gave oil a bit of a shot in the arm, and I think it's also partially responsible for what's happening to the yen again, because the commodity space and oil is looking quite green. Everything is up. That could weigh a little bit on the yen, together with I think month, quarter end, half year end flows. But that was an interesting little leak, if you want, by Macron. I think it's a bit politically driven leak to put pressure on the US to possibly hike the output. Yeah, that was mainly what I saw in addition to what you already mentioned.
Cool, fantastic. Thanks, mate. Stel, you got anything you want to add to the picture? Anything you've seen? I know you keep an eye on some of the data points and news headlines.
I mean, you covered it. The only other thing that's worth mentioning, and it's not really going to move markets, but it's interesting. Credit Suisse. Did you read about? They got. They were guilty of money laundering charges. So this never happens at banks. Never. But yeah, no. I mean, you covered it. Everything else.
It's Credit Suisse. They always if there is something going on, they're always in the mix. They have a first. I mean, hey.
Yeah.
Yeah, so it's surprising in this day and age. Drugs trafficking or something, wasn't it, to do with money laundering for drugs?
Yes, indeed.
I mean,
yes.
You know, these rules were tight in my day in the city, and so the fact that people can still get away with this sort of stuff in this day and age is beyond me. But as you say, if there's someone who's got their finger in that sort of pie, it's going to be Credit Suisse.
Yeah, actually, one other thing worth mentioning. You know, we've said for a while that data is becoming more and more important. We went through years, I would say, where data was not that important. It didn't really move markets that much. Now it's all starting to add up. I saw today French consumer confidence. Did you see that number? Same number, the lows that we had in 2008. So it just shows you how much the consumer is worried about where things are going. And frankly, it is it's very reasonable, because with inflation and the goods and the electricity, food, the main things you need to survive are becoming more and more expensive, and the top 1% are never going to care, but the bottom 50% are going to be in trouble. So that's something very important in my mind. It shows the state of mind of the average person.
Yeah, and we're going to get that from the US today at 3 o'clock this afternoon, and we get the US consumer confidence numbers. So again, another look. These are the main numbers rather than the Michigan. So a much wider survey, and within that are the inflation expectations again. So that's going to be a potentially big one, big price mover if there's a big variation there. So yeah, that's definitely something to look at this afternoon. So right, I want to bring in our special guest, Michael Brown from Caxton FX. And one of the reasons why I wanted to bring Michael in for this, he's very good on his general analysis of markets and what's going on. But it's the other side that I want to speak to him about, and that's the commerce side of FX, because this market isn't just a speculative vehicle. There is a lot of business done naturally in the FX market. If you look at your price platforms, just to see the scale of it, every 5th decimal pip move that you see there, every time that screen flashes a price, that's a trade. And if you think how many trades are going through every time your screen flickers, and this is just on your retail platforms, it's the same speed and the same frequency on the institutional platforms. There are trades going through hundreds of millions of pounds, dollars, yen, whatever, going through in seconds. This is a huge market, and it's not all speculative. So bringing in Michael here, that's their website here, Caxton FX. Just as some of the things you can see there, 6 things you need to know about buying a property abroad. Travel. It even comes down to spending your kids' inheritance. I like that one. Buying a powerboat, running overseas property, sending your kids abroad, studying abroad. There's 100 different things that the FX market is used for, and it's the same for me and Kate on the institutional side, where a lot of the business we were doing were to fill customer orders, and not all those orders were just people playing the markets. Just to take one quick example, when I was on the metal exchange working at Rudolph Wolf, we were big brokers. I went and visited one of our customers, which was Pirelli, the famous tire maker. Now, what many people may not know is Pirelli is also a big producer, or was back then a big producer of copper cables, industrial cables. They used to make sort of 6-inch diameter copper cables, and they were one of our biggest customers because of the amount of copper they needed to buy. So it's and K-Man, I'm sure, is the same thing. Not all his customers were people who were just playing the markets to make pips. They were actual people who needed to enact FX for their business. So I'll bring in Michael now. Welcome, Michael. So do you want to give us a bit of a rundown of what Caxton does on that side of things?
Yeah, cheers, Ryan. Morning, all. I think you've covered things quite well there. I mean, it is perhaps something that people don't consider when they're looking at the market. Particularly, probably a lot of people on this call are looking at it purely from a speculative point of view. And actually, the kind of deliverable commercial aspect of it, which obviously Caxton specialise in, both on the private side, which you've got on your screen, and also on the corporate business side as well, is huge, maybe even a bigger part of the market than the speculative stuff. And obviously, you've got to not just think about spot FX, which is what we all look at and talk about all day long, but also you've got the whole wealth of hedging contracts out there as well, forward swaps, options, all the rest of it, which we do for our clients and banks do for their clients and our competitors do for their clients. And all of this sort of sums up together to turn into actually a huge chunk of the order flow that you see going through the market.
So what percentage do you think general order flow through the market, what percent do you think is down to speculative, and what percent is down to filling orders for customers and stuff?
Well, I think I mean, that's a question that I don't think you're ever going to know the exact answer to, but I think it's I think the bulk of it is probably filling orders and, deliverable commercial foreign exchange going through the market compared to pure outright speculation. Obviously, that will change over time. If you're around the time of a big data release or a big policy decision, whatever it may be, then you're going to have more of the speculative stuff getting involved. But I think generally speaking, and particularly as you move towards things like, well, you mentioned it earlier, month, quarter, half year end value date today, big chunk of the flow that you're seeing going through the market is going to be commercial flows marking to that value date.
Yeah, and obviously some of that is purely down to balancing of portfolios. You've got investment or hedge funds or investment companies. They're only allowed to keep certain allocations, certain sizes in different assets.
Exactly that. Or you've got or sorry to speak over you, or you've got something that our clients do a lot. You've got corporates who need to repatriate overseas revenue on a monthly basis or a quarterly basis, or whatever their accounting policies are. And I think this can be quite often overlooked by players in the market, and actually that this is a big chunk of what's going on. If you've got a majority of investment funds that rebalance at the end of the quarter, if you've got a large amount of corporates that repatriate overseas revenue streams at the end of the quarter, all of a sudden you've got a massive driving influence on the market that could be moving in the complete opposite direction to what the fundamental and technical analysis would tell you. For instance, you might think there's no reason to be bullish on the pound. The BOE are one of the least hawkish central banks, inflation, growth slowing, etc., etc. But actually, if you've got a load of corporates who need to within London that need to repatriate their earnings into sterling, you're going to see the pound rally into month end, and that's when you kind of get into the realm of moves that happen but perhaps don't often make sense. Yeah,
that's absolutely right. And I was talking about month end yesterday, and those are the sort of opportunities I look for in month end. Is there moves? Is there flows that push a price out of kilter with the fundamentals? And because that then presents a potential trading opportunity for us retail traders. But obviously, it shouldn't be underestimated the size of the retail market. It has been growing. It is significant. If all the retailers move the same way, if everyone trades off the same moving average in euro dollar at one time, pure weight of money can move the market. But it's still a very individually, it's still very small. Me buying a lot or two in the market isn't going to do anything in the price, particularly on the interbank side. And that's something I wanted to ask Kay about, because obviously he's been in that side as well. But just before I ask him that, just a question that sort of ties that together, Michael. How, without breaking any confidentiality or anything like that, what's it like these days for trading for your clients? Do you have your own in-house platforms? Because I would assume back in back in the old days, a company like Caxton would have an account maybe with a bank, and you'd phone up if you got a big order. You'd phone up the bank and get a price and make your spread and give it to the customer.
Yeah.
Are you plugged in more these days?
So I reckon, I mean, I've been here for just over 6 years now. I reckon I can probably count on both hands the number of times I've actually had to ring a trader on a desk at one of our banks to get a price. And that might be because something was particularly exotic, or because, you know, there was an odd value date, or whatever it may be. But yeah, pretty much everything now is seamlessly plugged into as many liquidity providers as you can get, and that will just automatically give you your best price onto which you add your spread. Yeah, so there's very, very little now kind of personal involvement in the process. The computers basically run the show when it comes to engineering all the pricing.
Yeah, so to Kay then, you know, you were the guy on the desk who back in the day would get these types of orders. So, you know, what was the makeup in your sort of order flow between sort of specs and you know, people doing business?
Well, people doing the thing is, I've been market making spot FX for nearly 35 years, in various currencies, various pairs, various periods in time as well, and changing markets. But what always comes back is that, as already Michael was saying, and we have been saying already over the show, is that corporate flows. But you can imagine there's corporates on the one hand, but then you have a spade of other market intervenants that have absolutely no speculative interest at all. So you have the corporates on one side, and you can imagine, for instance, I spent a number of years in Japan. You can imagine the Japanese car makers having huge interests, but not only them. You have, like, just to name the one, Komatsu, for instance, who makes like heavy machinery that's been sold around the globe. They have heavy interests in the market, but it's totally non-speculative. Then you have central banks in the market, which may sometimes seem speculative or needing to intervene in their own currency, but they are regularly doing FX. For other reasons, because they are handling reserves which are moving with the moves of the currencies, and they just have to maintain a certain percentage of currencies in the basket. And when a currency moves, of course, the percentages move, and they need to adapt. So they are also intervenants. Then you have like asset managers who invest. Of course, investment can be somewhere compared to speculation as well, because you invest, so you think that is going to be your best investment. So there's somewhere speculation, but a lot of the asset managers have a fixed FX model. That means that their FX outstandings, which is non-base currencies, has to remain the same. So, for instance, if equities move higher in the States, and they have S&P, Nasdaq, Dow in the books, the value of their holdings in dollars, let's say it's a European asset manager, the value of their holding is dollars is de facto going up. So that means that at the end of the month or the quarter or the half year or the year, depending on how they hedge, they will need to do FX, and that's what we are seeing on the end of month, corporates, and also a lot of asset managers who trade on a FX neutral base, and those are actually, if you look at it over the course of a year, those are probably going to be somewhere in line with the big speculative funds, which are the hedge funds. But the thing is, the hedge funds, they are going to come into the market much more aggressive than corporates, central banks. Sovereign wealth are the other ones. If you look at the GPIF, the Japanese whale, big
Norway.
companies. Sorry?
Norway as well.
Norway, big insurance companies, they have like flows deriving just because the assets where they invest in move, and that has, at inception, it might be a speculative move, of course, because they think that's where their money will be giving the best return. But as soon as that is put on, the rest is virtually non-speculative move. It's just hedging what their models tell them to have, like, for instance, as I was saying, FX neutral position. So, and those flows can be huge, and they, as you already mentioned, and as Mike was saying, they are not directly linked to what the fundamentals can say at that time. But yes, they are huge. Well, it's dated now, but I've done $1 billion yen over one fixing for one of our clients, just over the fixing, because there was so much moves in their foreign assets that they needed to buy or sell $1 billion yen over one fixing. We had stuff where we did 2 billion cable, and then the rest is also M&A flows, for instance. They can also drive huge amounts. When you look at companies buying out a foreign company for $50 billion or something, or equivalent, not everything is done in loans or exchange of equities. There's usually a part of FX linked as well, and they have nothing to do with speculative moves.
Yeah, and it's also interesting to learn how, like you say, you have $1 billion to do in the market. Even when I was on the floor and you had big orders, you don't tend to, when you get these big orders coming through, you don't often tend to see it all get done at once. You don't get the market hit in one go unless someone's given you instructions to do that. So in most times when you get something like a big order, you drip feed it in. You'll have a bid level. Maybe they give you a limit price, i.e. you can trade down to that level or up to that level, and you just drip feed your orders in. But then that's where you see in your price charts where you suddenly see a support area, and it may come out of nowhere, and you think, well, why is the price keep bouncing off of there? It can be something as simple as there's a big flow in the market, there's a big order to put through, and whoever's trading it is just, every time it gets there, they buy it, they buy it, they buy it. When the price moves up, they stop. When it comes down, they buy it, they buy it, they buy it. Because not every sharp move is a short squeeze or a long squeeze or whatever. It can purely be someone's coming in with a big order and they need to fill it, and they either drip feed it in or they need to bid it up to a particular level. But what happens is you get the market front running things like month end. If the models say this, everyone jumps on board, and then you see the actual opposite happening. So it's the speculative side is well tied in with what happens in let's call it the institutional side, the business side of things. But Michael, what's changed in the industry? I know you're a relative youngster compared to us old dinosaurs. But what's changed on your side? Do you find that a lot of customers are looking at charts these days rather than, are they more interested in price levels and your analysis? Because you analyze markets as if you were a trader, if you know what I mean, or at a bank or something like that.
Yeah, exactly that. I mean, I think there's been a number of changes. We obviously touched on the kind of increased digitization of the whole space, for want of a better word, earlier on. But yeah, I think, just kind of looking at how clients' behavior has evolved over the last half a decade or so. I think people are much more plugged in to what's going on, and I think that's because information is now so much more freely available. Anyone can jump on and pull up a cable chart, in about 30 seconds and get a live price. I mean, it probably isn't the most accurate price in the world, but it gives them an idea, and they can zoom out and see where the market's been. So yeah, I think that's one big change, is that clients know what's going on much more, which is beneficial because it means we can have much better conversations with them, because they're coming from a base of knowledge where they know where spot is right now, they know where spot's been over the last month or so, and they know roughly the rate at which they've budgeted for the next 12 months or however long they budget for. I think the other thing that we've seen, and this was particularly true pre-COVID, and it's starting to become true post-COVID, is a big increase in the use of derivatives. So rather than in the past, a lot of kind of SME clients in particular would almost just take a bit of a gamble on the FX market and just put through their flow whenever they needed to do it. We've started to see a much more kind of disciplined approach, and actually things like forwards and options are now being used much more, and that ranges from, you know, the smallest of small businesses all the way up through to listed companies, and I think that's something that is worth bearing in mind, because what we're tending to see at the very least is towards the end of the month or the end of accounting periods, what used to happen was everyone would kind of just do their whole flow, whereas now people are just doing the bit that they haven't hedged. So actually that more disciplined approach means that volumes around those kind of peak times are probably quite a lot lower than they would have been in the past.
Yeah, that makes a lot of sense. Also, Michael, I have another question for you. Have you seen a change? And as we know, you haven't been in the market for decades, but have you seen a change, like compared to pre-COVID, let's say, or in the 5-6 years that you are there? Have you seen a change in spreads? We all knew that in the old days, when you were a small company, you didn't have the access to a trading desk. The spreads were like huge, but then we also saw have seen over the last decade that there's a lot to do about spreads and access to markets and things like that. Have you seen this kind of pressure on spreads also with your own, or in general in the company?
Massively, and I think that kind of stems back to the point I just made around how access to information has been democratized and is now so much easier, and we have, and that's on both sides, both in terms of our spread being pressured, but also the spreads that we're now offered from our banking partners are much tighter. So I think that's just a general theme across the industry of margin compression and spread tightening, and I don't think that's going to stop, really. I think that's probably something that's now quite a well-embedded theme and is going to continue. And it almost becomes a bit of a race to the bottom in the end.
Yeah, I know, because I mean, even as a retailer now, if you have the right platform, sometimes you get choice prices on platforms, on some platforms, where 20-30 years ago, people were paying a percent above or below the market. And I even recall, like, starting 5-6 years ago, on the other side of the fence, spreads were wider than what they were today. So when you were saying that people are using more of those, let's say, sophisticated instruments like forwards and options, do they really put on strategies where they lock in prices like long time in advance for possibly a year's production or a year's output or a year's sales, or is it still anywhere between 1 month and 6 months?
Yeah, so again, I think that's probably something that's changed. I would say that kind of the set and forget approach of just book a year forward and look at it in 11 months time when they need to re-hedge is pretty much dead, I would say. Now people are taking a much more kind of layered approach to things. I would say it's pretty rare to see anyone hedge out more than about 3 months in advance. That's probably a long time, I would say, for our client base. But what they're doing is they're doing that on a rolling basis. So they've got, 3 or 4 contracts out at a time, and they're just rolling each one every month to constantly have the same value, but just over a rolling kind of 3-month period. And that's then a layered strategy of some forwards, some options, maybe a few limit orders in the mix as well. So, but yeah, those timescales have massively come in, I would say, over the last kind of, actually probably the pandemic was a big catalyst for that, because you suddenly go from not a certain world, because it's never particularly certain, but a world where you know roughly what's going to happen over the next 6-12 months, to a world where you don't really know what's going to happen over the next kind of 6-12 hours. So I think that massively brought in the kind of timescales, and I think, just speaking to our client base, they find that works, and I think they're going to stick with that kind of shorter time frame hedging now. And of course, the other thing is, everything is now online. No one's really printing physical catalogs or anything like that, or physical labels for things. So there's not really a need to hedge out for that long, because they can just change their pricing in 3 or 4 clicks of a button if they really need to.
Yeah, absolutely. That's very interesting. So that in fact increases, let's put it that way, the day-to-day volume, but diminishes the volume that we used to see over peak periods of renewing contracts, which was like either the end of the year or around the end of the first quarter, where big periods, if I recall well. And of course, being in Japan, it was like everything about the end of fiscal year and the start of the new fiscal year. There was like huge peak volumes over there. But as you say, people have become much more dynamic in their style. So that must increase the daily volume, but reduces peak volumes, right?
Yeah, exactly that. Basically, what the sort of net effect of that is, you're just kind of smoothing out the volume over the month or the quarter or the year, rather than having these kind of big peaks and troughs. You're doing it in the same volume or slightly higher volume, but just spread over a more equal number of days. So you don't have periods which are really quiet with nothing going through. You do still have some spikes in terms of volume, but they're just perhaps not quite as obvious and large as they would have been in the past.
Yeah, and so can we derive from that existing seasonalities, and let's take the pandemic again, like pre-pandemic existing seasonalities have now watered down?
Yeah, I think watered down is a good way of putting it. I don't think they've completely evaporated. There are still going to be some in there that are likely to hold true for a while. Sterling tends to have a promising April. That's always been pinned on tax repatriation. I've never quite liked the reasoning for that, but that one seems to be holding relatively strong. But I do agree that as the flow is kind of evened and spread out throughout the year, the impact of seasonality is going to be lessened quite significantly, you'd imagine.
Okay.
I think that's something that's happened, like you say, due to information flow and globalization. I think that's something that's happened. Some of the old themes. Look at US summer driving season was always a potential big move of oil. And that's washed out now. The Hacienda put, Mexico doing their big oil hedges. First quarter of the year, that sort of thing. All these different things that used to have a big impact years ago are having less of an impact in this day and age.
Yeah, but I guess that's only natural. Over time, certain edges wear away. I mean, you mentioned earlier that month-end flows, you have the banks putting out their rebalancing models and all the rest of it. And I mean, I think people probably start front running those at the start of the previous month. At this rate, they're so well communicated, and those edges wear away, and then new edges come back into the market.
Yeah, but and you're right, and I think it's also important to then, because from a trading standpoint, from a retail trading standpoint, if we're saying that things like fixes and end of month aren't necessarily going to be as big as they used to be, that in itself can present opportunities. I mean, just to take one example, the old BUBA trade, when the Bundesbank would come in and convert euro sterling for the UK's payments to Europe.
Yeah, of course.
That was always a thing that you used to watch for. Suddenly you'd see euro sterling spike up 20-30 pips. No one looking them all in, and everyone would go, hey, that's BUBA.
That was even still existing when we first met, Ryan. We were still talking about the BUBA fixings right then. And then after a while, well, of course, now after Brexit, it went out of the window. But I mean, a lot of things have changed in that sense, right?
Yeah, but therein lies other opportunities, So if fixes these days aren't going to be as big, if you do get an exceptional one, then that's when you need to look a bit more closely and see, is that price move pushing something out of kilter with the fundamentals? You know, one of the things I'm looking at right now is dollar yen, you know, pushing up to this 136 again. You know, it's been soft coming off the highs and hasn't looked like it wanted to ramp higher again. It's been doing a bit of sideways action since we had those 136.70 highs. So I'm keeping an eye on this. Is it oil? Is it end of month lows? If we get a move up towards these highs, and it looks pretty spiky, and there's no real fundamental change or comments or change from the Bank of Japan, then I'm going to be very interested in looking at shorts to see if it fades after the month end. You know, see where the price goes. Keep it fairly tight and see what happens. And the same with other pairs. You know, euro dollar been ranging 104, 106, or stuck between 105, 106s, you know, for weeks. If this is a time where that's going to come out of that range and it's not driven by ECB news, by data news, by anything else, again, I'm going to be thinking this is a fixed move. So the fundamentals haven't changed. There was a reason the price was trading where it was. Now it's not trading where it was. Is that something I'm going to look to fade? But again, looking for those exceptional moves, you know, trading around, you know, 105.80 to 106.20 is a tight market to trade in. That's not really my bag. I want to look for a big move outside of those things. But just to shift it a bit, Michael, because you are very good at your economic analysis and fundamental analysis and price analysis. So putting you on the spot, what do you think is going to happen with the ECB in July?
You have to ask me about my favourite people in the world, don't you? What do I think is going to need to be? I think they'll go 25. I think I agree with you. I think those inflation prints that we're going to get this week are going to be important. I think they go 25 July, 50 September. But I think that whatever the ECB do, I just can't see this ending well. They're trying to hike rates while keeping yields low in Italy and some of the other periphery countries, while keeping spreads relatively contained and trying to keep the euro at a fairly stable level. I mean, the ECB couldn't run a bath these days, let alone try and do all four of those things correctly. So I think the market is going to probably end up testing them on this new tool that they've announced to try and keep the BTP Bund capped. 250 basis points seems to be a bit of a line in the sand there. So they're going to hike rates. Whether they can hike rates and control the bond market as they want to remains to be seen. But I think the ECB are probably going to have to get relatively aggressive relatively quickly if they do want to get rates to a decent level, because the speed at which the Eurozone economy is slowing, and just looking ahead to, I mean, already we're talking about Q4, an energy crisis. The Eurozone economy is going to have a pretty grim fourth quarter of this year. So the window for the ECB to get a decent policy response into inflation, to then give them room to do more when the inevitable slowdown and recession comes, is a very, very narrow one. So 25 July, 50 September, maybe 50 in October, and then I think growth is probably going to force their hand into saying this is all we can do. But really, I think that the challenge for the ECB is trying to effectively move the bond market in the opposite way to which bonds should be going, and that's something that is unlikely to end well for anyone.
So who do you think is going to come out of all this rate hiking looking the best or not being the worst, if you had to pick go through all the major economies?
Yeah, I mean, that's a difficult one. I certainly don't think it's going to be the BOE. I think the BOE are being far too timid when it comes to taming inflation. We're almost looking at a situation now where the economy is going to slow, whether the BOE hike 25 or 50. Why not just hike 50, get this out of the way, try and just signal that you're trying to control inflation? Whereas we're going to end up in a worst of both worlds, where rates are too high to sustain growth, but they're not high enough to control inflation. So I think actually the Fed are probably going to come out of this looking all right. The Bank of Canada are probably going to come out of this looking in a relatively solid position because they are being aggressive. And you can argue until the cows come home whether or not rate hikes are the way to solve issues with inflation on the supply side. But I think what the Fed have been very clear they're trying to do is actually anchor inflation expectations again. That University of Michigan survey where I think it was 5-year inflation expectations with 3.3%, I think it was, before they hiked 75 basis points, that really spooked policymakers. So the Fed and the Bank of Canada, I think they're going to come out of this looking pretty good. They've got the situation slightly easier because they haven't got the issues with energy that we have here in Europe. But yeah, I think the Fed, the BOC doing a relatively decent job. The Bank of England and the ECB are in a world of trouble.
Cool, thank you very much. I agree with a lot of that. Actually, well, our views are pretty much aligned, as we know from our chats on Twitter and elsewhere. Just to swing it back quickly, sorry, Kate, just a quick question from one of the viewers, if you can answer it in a roundabout way. I know you may not be able to give out specific names and stuff, but Andrew Pertz asked, who are the big liquidity providers these days? Is it banks? Is it secondary institutions? What sort of?
Yeah, I will have to give a very vague answer and just say banks. I can't really say any more than that, unfortunately.
I'm outside the market. I'm a private trader, so I can give my point of view on that one.
Go
for it.
I don't care if my employer kicks me out. It's me. No, I think it has changed a little bit. We in banks, we used to be the liquidity providers, in a way helped or seconded by hedge funds and some asset managers who were leaving bids and offers, and the banks gave liquidity. And I hope the question from Andrew is related to FX, because other markets I'm a little less knowledge about other markets, but it's changed a bit throughout the years. I think actually the role of banks is a bit of a ebb and flow kind of thing. In the pandemic era, I think banks and central banks, in a way, thanks to their liquidity injections, have taken back the liquidity provider role. But in normal days, I think it's a little less obvious that banks are the only liquidity providers. I think a lot is going on through the huge asset managers. Think about the BlackRocks and all those.
Yeah, and I think that's an important point you make, because from your days on the bank, if you were sitting there, quoting prices, if you suddenly saw a price, put in a big move, probably within 30 seconds, 2 minutes, you'd know who was doing what in the market, because you'd phone around or you'd start getting calls, for pricing. You'd get to know who was doing what in the market. But these days, because there's so many different people plugged into the liquidity platforms, it's harder to from a desk point of view, to pick up who's doing the flows, and it comes much later. I used to see the same thing on the life floor. I was a local, which was a self trader, the example of a retail trade in the life floor, and the local's role was actually to provide liquidity to the market. So if you were local, you had to always give a two-way price if asked. But the reality was that the locals were just, in effect, retail traders. We were just trying to make a few pips. And the real liquidity providers were the banks and the institutions, because they had the size. But you got to know the flow. You got to know Barclays had a big order going through. They were always on the bid at 05 or something. And every time you asked what was there in the market, there'll be 5 bid on 200. Then you'd see them trade 300 and ask what was there, and they're 5 bid on 200. You'd get an idea of the size of stuff going through. But now, it's I'm sure you'd agree, Kate, it's much more difficult to find out who's doing what in markets. One, because of MiFID rules and new regs. But we've lost the access to that order flow.
Let's put it that way. I stopped market making in end of 2015, right? And I've been market making markets since 82, and we used to have to call out banks before to have we had two-way relationships with banks, whether it be the A list or B list or the main banks. You could call up for 50 or 100, and then there were the FX brokers who were also sometimes having really good wet fingers. They knew where the wind was coming from, and they kind of had the support of the main banks to even put some liquidity on there. So we went from that, and then we went onto the platforms, onto the e-commerce platforms, the Reuters, the EBSs, the Quotron and stuff in those days. So more banks and less important banks got access to liquidity then. And then as time went on, and especially after the euro, the dot-com crisis, things evolved in an absolutely dramatic way for market makers and market interveners. We started to have central banks and some other interveners have direct or semi-direct access to the markets, and this has evolved until the fact that, for instance, after, let's call it from 2008, 2009, it had evolved in such way that I had an aggregator in front of me, aggregating, I think it was at the end 13 or 15 platforms. I didn't have a clue who I was trading with until the whole confirmation, the straight through processing process had been done. I didn't even know who I was trading with anymore in the end, and it didn't really matter. Yes and no. It mattered if you always ran into the same people, because we had our other platforms and the brokers still on the side. If you're always running, but at the end, it was evolved in that way that you don't know anymore who is giving the liquidity at a certain point of time in the market. So, and I guess
I guess you just felt more like a button pusher than a market maker, I suppose. Which is
yes and no, because we still made markets. It's not like you could go on a platform and sometimes you could, but if you would sell $400 or $500 million against something, it would still move, and then you might flip over algos, and then it moves and it accelerates. But let's say the day-to-day liquidity, yes, you didn't know who was on the other side of a trade anymore, because you could sell like $100 yen and have I don't know 30 trades, but there could be one of 20 million, another one of 30 million, and then 20 trades of 1 million or less, you know.
Yeah. Another quick question, Michael, if you may, from Alexander. How do you see UK inflation going in the next 6 months, especially if the BOE carry on what looks like to be a dovish stance compared to other central banks?
Quite a lot higher, I would imagine. Of course, the UK a little bit different to everywhere else in that we've got the energy price cap, which is going to come in October, and that'll be up another 40-50%. So yeah, I think the BOE is saying 10-11% by the end of this year, nearer 11%. I think that is probably going to be a bit of an underestimate, judging by how their forecasting track record has been of late. But you could then end up in a situation where sort of early 2023 demand has been destroyed to the extent that actually inflation comes back lower quite significantly if we enter a pretty steep slowdown or recession. So yeah, I think the BOE are probably lowballing it on their guesstimates at the moment, but that comment is right. The BOE much more dovish than anywhere else, policymakers much more concerned about risks to growth than they are about risks to inflation, which is really in contrast to every other central bank. I mean, even the SNB are hiking by 50 bips a time to try and get a handle on inflation in Switzerland. So I think that divergence is going to shine through tomorrow on there's a panel, Powell, Lagarde and Bailey, and actually I think Andrew Bailey's going to stick out like a bit of a sore thumb on that panel, talking about how growth is weakening when everyone else is saying do your job and get inflation under control.
I agree.
We'll give him the little chair at the end.
Yeah, Michael, can I ask you about and I don't want you to judge Bailey. I can do it myself. I think he's the worst central banker I've seen in a long time. But do you think that somewhere it has to do with his background as a regulator, that the guy is ultra prudent?
I think so. I think there's two things. I think one is that he is ultra prudent and incredibly risk averse. I think that's just the nature of the bloke. And I think the second thing is I get the impression that he is very academic, very kind of focused on, you know, how the textbook says things should be and how the textbook says things should react and what the various models the BOE have say they should do, rather than necessarily acting based on a little bit of common sense and actually looking at what's going on. And I think probably the clearest implication of that was when he started telling people not to ask for a pay rise when he's on £500,000 a year, which just kind of shows, I think, you know, the guy is woefully out of his depth.
Thanks.
Yeah, and I think you're spot on with the inflation side of things. You know, you can say if the Bank of England hike and that does see, you know, activity really crumble in the UK, that's going to be proper stagflation, because energy prices, unless they collapse, they're not going to come down through that situation. You know, people aren't, you know, spending on energy excessively. This is just the normal everyday spend they're doing, and the price has gone up 40-50%, going up again. That's not going to change even if inflation falls, unless those energy prices come screaming down just as quickly.
Yeah, and we're already, I mean, you're already seeing, you know, retail sales are off a cliff. Consumer confidence is at its lowest, I think, on record. I read on Friday. There's no sign of that improving. You know, people are getting squeezed and squeezed and squeezed, having to tighten their belts more and more and more, and there's no sign of that stopping. So yeah, unfortunately, I think the UK is really in trouble. Yeah,
but on the flip side, you know, you never write off the UK and its resilience. You know, people will be screaming of the pound going to parity or 110 or something silly like that. But if there's an economy that tends to bounce strongly after adversity, it can be the UK. So never write us off too quickly.
I'd agree with that, and thankfully we haven't heard anyone calling sterling an emerging market currency lately, so hopefully that nonsense is gone as well.
Yeah, I think part of Bailey's problems is I heard he wears brown shoes. I had to get that one in somewhere along the way.
At least he wears a tie.
Yeah. Well, let's wrap it up now. I want to say, just to sort of summarize what we've been talking about, it's just to give you guys and girls an insight that, you know, the market isn't all about everyone trying to scheme a pip, trying to hit your stops, trying to knock you out and play nefarious games. Yeah, that does happen, but often it's on a way higher plane than we see on the retail side. But also just give you insight that not every move is down to speculation. There are some times when you'll see a price move and it'll purely be because of an M&A flow or because someone's got to, you know, repatriate some profits. So just factor that in when you look at the markets. Don't get on the clickbait side of things when you're trying to trade. You know, take an objective view of things. But anyway, thank you very much, Michael, for coming on. Hopefully we'll see you again on a future show. It's always a pleasure to speak to you here and live and on Twitter and elsewheres. So thank you very much, mate.
Yeah,
no worries at all, Ryan. Cheers for having me. Thank you, gents.
Cheers, guys, and thank you, folks, for coming to the show. And watch out that US consumer confidence data later, and we shall see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.